Hello friends, my name is Pawan. I am a chartered accountant. I have been taking classes for the students appearing for the CPT exam for the last 6 years, and I would like to share my knowledge with the students who are going to write their exams in the month of December 2012. For the sake of those students, I am discussing the fundamental accounting concepts, and I think this will be very useful for the ensuing exams. I hope that within the next half an hour, you should be able to understand, grasp these concepts. Okay, I would like to make these concepts very simple for you, and just follow. Okay, let us discuss the first concept. First concept is called as the entity concept, or it is also called as the separate entity concept, or it is also called as the business entity concept. Now, what do you mean by this concept? Now, as per the separate entity concept, the business is considered to be a separate entity. The business and the owners are considered as two separate persons. We consider the business as a person, that is called as the separate entity concept. Now, why do we want to treat the business as a separate person from the owners? The reason behind this is, we are going to maintain separate set of books of accounts for recording the transactions of the person called as the business. We maintain separate books of accounts for recording the transactions of the business. Now, why do we maintain separate set of books? The reason is very simple. The owner, he is a very wealthy person, or is a very rich person. He has started his business, he is doing business. He wants to know what is the profit or loss which he has got because of the transactions done during a year. He wants to know whether his business is doing well or not. He would ask the accountant, we have been doing business for the last 1 year. Please tell me whether our business is making profits or losses. In such a situation, the accountant would have to answer the owner. He would have to say whether the company is making profits or losses, whether the business is in profits or losses. Now, how would he be able to do that? He can answer that question only if he has maintained separate books of accounts for recording the transactions of the business. So, the accountant will record all the transactions of a person called as the business in separate books of accounts which have been kept only for the sake of recording the transactions of the business. Now, in these separate set of books of accounts, the accountant will not enter the transactions of the owner. The owner is a very rich man. He has made investments in land. He has made investments in fixed deposits. He has invested his money in shares, and he is also doing a business. If the accountant of the business starts recording the income from the fixed deposits, or the income from the land, or income from the building which is owned by the owner of the business, if he starts recording, if he starts including the income in the books of accounts of the business, what will happen is, the business will show a lot of profits. The profits of the business will be very high. But actually the business may be making losses. The business is showing high amount of profits just because the owner's income from dividends, owner's income from interest on fixed deposits, owner's income from by way of rent from his land and buildings, all have been included in the business books of accounts. So his personal incomes have been recorded in the business books of accounts, because of which the profit and loss account of the business may show a lot of profits. Actually, the business was not doing well, there were a lot of losses. But just because the owner's personal incomes have been recorded in the business books, the business is showing a huge amount of profits, and that is not the case. So, to find out whether the business is doing well or not, we have to record the transactions of the business separately. We cannot mix them with the transactions of the owner. So that is why we treat the business as a separate person, and for this person we are going to maintain separate books of accounts, and all the transactions of the business will be recorded in the books kept for recording the transactions of the business. The owner's personal incomes, the owner's personal expenses which do not have any relationship with the business cannot be included or cannot be recorded in the business books of accounts. This is called as the separate entity concept. I will summarize. The business is considered as an entity. It is considered as a person separate from the owner. Business is separate, owner is separate. Now, examples where we have followed this concept, there are certain situations where we have already followed this concept. See, when the owner contributes capital, when the owner brings capital into the business, the accountant will record the capital as a liability. Why does he record it like that? He records it like that because the owner is an outsider. He has given some money to the business. According to the accountant, business is a person. So somebody else has given some money to the person called as the business. So it's a liability for the business. We have to repay this money to the owner whenever he demands. That is why we show capital contributed by the owner as a liability in the balance sheet of the business. Similarly, when the owner withdraws money from the business, or when the owner takes away some goods from the business, or when the owner has taken away an asset of the business for his personal use, we show it as drawings. Drawings can be shown on the asset side of the balance sheet. Now, so an outsider called as the owner is taking away cash, he is taking away goods. So he is taking away money from the business. So we show it as an asset because he has to give the money back to us. So because we follow this concept, we show the capital contributed by the owner as liability and we show the drawings of the owner as an asset. Okay, so this is called as the separate entity concept, treating the business as a person separate from the owner. Okay, I think with this the concept would have become very clear for you. Now let us go to the second concept, money measurement concept. Now what do you mean by the money measurement concept? This concept is very simple. As per the money measurement concept, only transactions and events which can be measured in terms of money can be recorded in the books of accounts. If you cannot measure a transaction with a scale called as money, if you cannot measure a transaction in terms of rupees, you cannot record it in the books of accounts. See, I'll give you an example to understand this point. Now, let us say the CEO of the company is sick. He is having heart surgery. He is undergoing a heart surgery. He is not there in India. He has gone to US to get his surgery done. Because of the absence of the CEO, the operations of the company are affected. The company is not doing well because there is nobody to direct, there is nobody to lead. But can you record an entry for this transaction? Tell me what entry you can pass for this transaction. It's not possible to pass a transaction for this entry. So ill health of the manager, ill health of the CEO, these things have significant impact on the business. But we cannot record these transactions because it cannot be measured in terms of money. Simple. Or I'll give you another example. A competitor, let us say you are doing a business. You are doing a business of buying and selling goods. You are having a big store, you are running a supermarket. And next day, a competitor comes and he also opens a supermarket just beside your shop. Now what will happen? Definitely your sales will be affected. There was a time when all the customers of the locality came to your supermarket, they bought goods from you, you got a lot of sales. But now what has happened? A competitor has come, he has opened a supermarket just beside your supermarket and most of your customers have started going to that shop. You are losing money, you are losing sales. But is it possible to record a transaction for this particular event? It's not possible. It's very difficult to record a transaction. I'll give you another example. You are giving very good working conditions to your workers. You have provided them with a lot of facilities. You have provided them with air conditioning. You have provided them with playgrounds. You have provided them with badminton courts. You have provided them with carom boards. And they have a lot of fun, entertainment at the office. They feel very happy to come to the office. Can you measure their happiness and record them in the books of accounts? It's not possible to do that. But that happiness definitely affects their productivity. They work well, they produce more goods, and because of which the cost reduces, your company is able to do more sales and your company actually succeeds. But is it possible to record the happiness of the workers in your books of accounts? It's not possible. So only transactions and events which can be recorded in terms of money can be recorded in the books of accounts. That is called as the money measurement concept. Okay. Let us go to the third concept, going concern concept. Now, what do you mean by the going concern concept? Now, going concern concept means the company, your business organization, is going to continue in the foreseeable future. We assume that our business will continue in the foreseeable future. The size of the business will not be curtailed. We assume that our business will keep on going in the future, and it's not going to be stopped. It's not going to come to an end. That is called as the going concern concept. You say the company does not have an intention, or it does not have the necessity to close down. That is called as the going concern concept. You don't have either the intention or you don't have the necessity to close down. That is called as the going concern concept. Now, we already follow going concern concept in many situations. I'll give you an example. When you buy machinery, what is the entry you write? You write the entry, machinery account debtor to cash account. What's the logic behind the entry? We say machinery, it's an asset, real account, coming in, debit, cash, real account, going out, credit. We treat machinery as an asset. We show the machinery in the balance sheet asset side. We don't debit the machinery to the profit and loss account. We show the machinery in the asset side of the balance sheet. Every year we cut a small piece of the machinery value and we debit it to the profit and loss account. And slowly the machinery is depreciated. Now, my question is, why do you treat machinery as an asset? A simple answer comes, machinery is going to give me benefit for more than 1 year. It's going to give me benefit for 10 years. That is why I treat the machinery as an asset. It's not an expense. Expense is something which has to be debited to the profit and loss account. Asset which is going to give us benefit for more than 1 year, it should be shown in the balance sheet. That is what we learn. Now, my question comes, why do you need the machinery for the next 10 years? Simple question, why do you need the machinery for the next 10 years? The answer comes because my business is going to continue for the next 10 years. My business is not going to close down in the next 10 years. So when you are purchasing machinery, you have the intention of using this machinery for the next 10 years because you are going to continue your business for the next 10 years. So you expect your business to continue in the future. So that is called as the going concern concept. Now, the application of this concept, there are many applications for this concept. Very, very important applications. The distinction between capital expenditure, revenue expenditure depends upon the going concern concept. Now, what is a capital expenditure? It is an asset. What is a revenue expenditure? It's an amount, it's called as an expense which has to be debited to the profit and loss account. The distinction between capital expenditure and revenue expenditure depends upon going concern concept. See, I think you would have already learned joint venture accounts. Let us say a business has been started only for a period of 1 year. Within 1 year, the business will be closed down. So the total duration of the business is only 12 months. You know that after 12 months the business is going to close down. In such a case, there is no difference between a revenue expenditure and a capital expenditure. Even if you purchase an asset, even if you purchase a furniture, even if you purchase computer, even if you purchase machinery for this period of 12 months, there will be no difference between an asset or an expenditure. Because both of them are going to give you benefit only for 1 year. In such cases, the distinction between capital expenditure and revenue expenditure vanishes. There is no difference between capital expenditure and revenue expenditure. So, going concern concept is very, very important. See, if the going concern assumption is violated, that means you assume that the business is not going to continue in the future. In such cases, you cannot show assets at cost price. You cannot show assets at cost price. The assets have to be shown at realizable values. A fire accident happened at your factory and all your machinery is destroyed, all your stock is destroyed. It has become doubtful whether your businesses will continue in the future or not. In such case, it is meaningless to show that I have purchased assets worth crores of rupees. It's meaningless to show machinery at crores of value in your balance sheet. Because all the machinery is destroyed in fire. If you sell it in the factory, you will get only the ash value. You are only going to get the value for the ashes. And it's going to be very, very less. In such a situation, In the balance sheet, it's wrong to show the assets at their cost price. We have to show them at their realizable values, the value which we will realize if we sell it in the market today. So going concern concept also affects the value which you show in the balance sheet for your assets. So I think you are able to understand the going concern concept now. We assume that the business will continue in the foreseeable future. The size of the business will not be curtailed. There is neither an intention to close down your business, nor there is a necessity to close down your business. That is called as the going concern assumption. If going concern concept is violated, if the going concern assumption is violated, there is no difference between a capital expenditure and a revenue expenditure. The difference between an asset and an expenditure depends upon the going concern assumption. If the going concern assumption is violated, all the assets in the balance sheet have to be shown at their realizable values. We cannot show them at their cost prices. This is called as the going concern concept. Now, let us come to the next concept, accrual concept. Accrual concept, or you can call it as the accrual basis of accounting. It's also called as mercantile system of accounting. It is different from cash basis of accounting. Now, what do you mean by accrual basis of accounting? What do you mean by mercantile basis of accounting? The meaning is very simple. You have to recognize revenues when they are earned. You have to recognize expenses when they are incurred. I'll repeat again. We have to recognize means to record. We have to record revenues when they are earned. We should not wait for realization of cash. Expenses have to be recognized. Expenses have to be recorded when they are incurred. You should not wait for the payment of the cash. That is called as the accrual concept. Now, the question comes, when should I recognize revenue? What do you mean by revenue? See, when we sell goods, the value of the goods sold is an income for the business. It is revenue for the business. You are in services business. You provide a service to your client. As soon as the service is provided, the value of the service provided to the customer becomes revenue to the business. It becomes income to the business. You have given 10 lakhs rupees loan to somebody who needs it. He has used that money for 1 month. He has to pay interest to you. We have earned interest. This is called as revenue. So when should the revenue be recognized? As soon as the goods is sold, the revenue is earned, it has to be recorded. As soon as you give a loan after 1 month, you have the right to receive interest. You have to record it because somebody else has used your resources and he has to pay you money. You have to show it as an income. You have provided services. The value of the service provided to the customer has to be shown as an income in your books of accounts. We should not wait for the realization of cash. See, when goods are sold for cash, the concept becomes very simple. Show the value of the goods sold as an income and debit the cash account. If you sell goods on credit, again show the value of the goods sold as an income, credit the sales account, but because money has not been received, you have to debit the customer account or you have to debit the debtor account. So we record the income in our books as soon as we sell the goods or as soon as we provide the service, or if somebody has used our resources, after a period of time he has to give us some consideration in return. We have to show it as an income. So as per the accrual concept, revenues should be recognized when they are earned. We should not wait for the realization of cash. Now, expenses also should be recognized when they are incurred. We should not wait for payment of cash. I'll give you a small example. A worker is working in your factory. He has worked for 1 full month. We have to pay him 5,000 rupees as wages. 1 month is over. He has worked. We have received the benefit. We have not yet paid the money. Now the question comes, should we wait for the payment of cash to record it as an expense? Should we record the wages as an expense only when the cash is paid? The answer is no. As soon as he has worked, you have enjoyed the benefits. You have to pay him money. Whether you pay the money now or not, it doesn't make a difference. You have to recognize wages as an expense immediately. You have purchased goods worth 1 lakh rupees on credit from a supplier. Should you not show it as an expense? The answer is yes. As soon as you have purchased the goods, you have received the goods, you have signed the invoice, the goods have to be shown as an income in your, they have to be shown as an expense in your books of accounts. Because we have already received the goods, we have already signed the invoice. You have to pay money to the supplier, whether we pay it today or whether we pay it after 1 month, that doesn't make a difference. You have to immediately record it as an expense. That is called as the accrual concept. Recognize revenues as they are earned. Don't wait for the realization of cash. Recognize expenses as they are incurred. Don't wait for the payment of the cash. That is called as the accrual basis of accounting. Now, what do you mean by cash basis of accounting? It's contrasting. Cash basis of accounting, as per the cash basis of accounting, we can recognize income only when it is realized in cash. So we record incomes only when it is realized in cash. And when do we record expense? Only when it is paid in cash. So there is a big difference between the accrual concept and the cash concept. I think by now you would have understood the accrual concept. I'll give you the examples where we follow accrual concept. When we purchase goods on credit, we show the value of the goods as an expense. Whether we have paid the money or not, we show it as an expense, an example of accrual concept. When we sell goods, the value of the goods sold is shown as an income in our books of accounts. It is also an example of accrual concept. Workers have worked in our factory for the month of December. We have not paid them wages. Still, we have to show the wages of the month of December as an expense in our books of account. This is also an example of the accrual concept. You have deposited money in a bank. You have made a fixed deposit in a bank. You have earned interest for the month of January. You have not received it. You have not gone to the bank and taken the money. But still you have to show the interest earned for the month of January as an income in your books of accounts, even though you have not received money. This is also an example of accrual concept. So goods purchased on credit, goods sold on credit, outstanding expenses, income receivable, all these are examples of the accrual concept. I hope the concept has become clear for you. Okay. Now, what do you mean by the periodicity concept? What is periodicity concept? It is also a very simple concept to understand. See, if you want to find out the profits of a business, you want to find out with a lot of accuracy what is the profit earned because of doing this business. You want to find out that. You can find out the exact profits earned because of doing this business only when the business comes to an end. I think you will not be able to understand what I am saying. I will give you an example. A trader, a businessman started his business, let us say in 2001 with a capital contribution of 10 lakhs. A trader, a businessman started his business. In the year 2001, he introduced capital of 10 lakhs into the business. He did business for the next 10 years. In 2012, he felt that he has become very tired. He is not having the energy to continue the business. He decided to close down the business. In 2012, he closed down the business. He sells away all the assets of the business. Not his personal assets. I am not talking about his personal assets. He sold away all the business assets. He realized a lot of money. He repaid all the creditors, he repaid all the bank loans, and he was left with 1 crore rupees. He sold away all the assets of the business, he paid all the creditors, he paid all the loans, he paid all the bank loans, and he is now left with 1 crore rupees. Now, the exact amount of profits which he has earned is 90 lakhs rupees. I'll add, this trader, this businessman, never added even a single rupee during the last 10 years. He never introduced even a single rupee from 2001 to 2012. He introduced 10 lakhs in the beginning, and after that he has never introduced even a single rupee into the business from his personal pocket. And he never took even a single rupee from the business to his home for the next 12 years. He never introduced 1 rupee from his pocket into the business, and he never took away 1 rupee from the business to his home. Starting, he introduced 10 lakhs, and at the end of the business he got 1 crore. The difference between this 10 lakhs and 1 crore is the profits earned by him, 90 lakhs. This is the exact amount of profits which he has earned. But the question comes, what should I do with this exact information? What will I do with this exact information? The answer is nothing. See, we would like to continue our business for the future, and we don't want to stop our business to find out our exact profits. So it's meaningless to find out exact profits. If you want to find exact profits by closing down your business, it's meaningless. So we don't want exact information about our profits. So what we do is, we divide the economic life of the business into intervals called as accounting periods. The economic life of the business is divided into intervals. Each interval is called as an accounting period. Now, generally, I think when you are preparing a trading account, profit and loss account, we write the heading trading account for the year ended 31st December 2012, profit and loss account for the year ended 31st December 2012. That means we are preparing a trading account for a year which started on 1st January and which has ended on 31st December. So our accounting period here is 1 year. We have divided the life of the business into accounting periods, and generally we take accounting period as 1 year. Now, sometimes accounting periods are calendar years. What do you mean by calendar year? Calendar year is a year which starts on 1st January and which ends on 31st December. That is called as a calendar year. Some businesses use financial year. What do you mean by financial year? Financial year starts on 1st April of this year and it ends on 31st March of the next year. So generally we take accounting period as a period of 12 months. We take 1 year as our accounting period. Now the question comes, why are we preparing trading account, P&L account for a period of 1 year? The answer comes, we are preparing trading account, P&L account for a period of 1 year because in 1 year we cover all the 4 seasons, or how many other seasons may be there, we cover all the seasons. If we prepare a trading account for 1 month, let us say, if that 1 month is the boom time or is the season for our business, in such cases there will be a lot of sales, there will be a lot of turnover, you will show a lot of profits. Next month, if you prepare trading account for 1 month, next month, it is an off season. There will be no sales, there will be no expenses, there will be no profits. We will feel that in this month we have made a lot of profits, in next month we have made losses. But that is not so, because in the season months, I think there are many businesses which have seasonal fluctuations. So if you are doing a business which is affected by seasons, in such a case, if you prepare trading account, P&L account for a period of less than 1 year, then your trading account and P&L account become uncomparable. I hope you are able to understand the point. Okay. So generally we take 12 months because 12 months will have all the 4 seasons in it. And if we prepare trading account for 1 year, all the trading accounts are prepared for 1 year, it's easy to compare them. Okay. And all seasons will be covered by this. That is called as the periodicity concept. We divide the life of the business into intervals called as accounting periods, and generally we use a calendar year or a financial year as our accounting periods. And for this 1 year, whatever transactions have been taken place or whatever transactions have taken place, we record them, we prepare a trading account, P&L account to find out what were the results of the activity which took place during this period of 1 year, to find out whether there are profits or losses, to understand whether our business is doing well or not. That is called as the periodicity concept. Okay. Now, let us come to the next concept, that is the cost concept. Now, what do you mean by the cost concept? The concept is very, very simple to understand. I think we all know how to prepare a balance sheet. When we are preparing our balance sheet, we show machinery, we show furniture, we show computer, we show buildings, we show land, we show vehicles, we show all the assets at cost. What do you mean by cost? See, for purchasing machinery, for purchasing our assets, we would have paid some money to buy these assets. So we show the assets at the cost price which we have paid or the cost which we have incurred to acquire them. That is called as the cost concept. So we show all the assets in our balance sheet at cost price. The amount which we have paid or which we have incurred to acquire the asset, we show the assets at that value. That is called as the cost concept, or it is also called as the historical cost concept. Now, see, in the case of assets like land 10 years ago,